Most major financial institutions, including JP Morgan, Morgan Stanley, and Bank of America, have lowered their EPS forecast for the S&P 500 in the year of 2023, meaning that if their forecasts are correct, the S&P 500 is grossly overvalued where it is currently trading at. We talked about that in the last video, but it's important to remind you guys of this as we get into this, and it is the divergence you are seeing in the bond market with the stock market, and it's quite crazy, guys. So let's get into all of that information. I do want to talk about the rest of this week because we are going to have important data coming out tomorrow, December 9th. That is Friday. And it's going to be very exciting, guys. So let's get straight into it. Hit that like button and subscribe to the channel if you have not already. And first things first, guys, the bond market is going crazy. The bond market is breaking. And let's talk about exactly what I mean by that. So what we have seen throughout 2022 has been the bond market has been crashing, right? No surprise. The stock market has been crashing. Have you guys ever heard of a 60-40 portfolio? 60% of your portfolio being invested in stocks, 40% in bonds. Well, that's why the argument is coming up that the 60-40 portfolio might be dead. It's to say that if bonds have a really good year, stocks are probably going to have a negative year. If stocks have a really good year, bonds are probably going to have a negative year. They kind of offset each other, and they're kind of like a hedge. That's why if you own both, well, you're not going to miss out on a bond rally, you're not going to miss out on a stock rally, and hopefully you won't get destroyed by one sector or the other. But what has happened in 2022 is they have both fallen off a cliff. This has been very abnormal. We've seen a very positive correlation between bonds dropping, right? Yields going up, bonds dropping, and stocks dropping as well. But what has started to happen over the last couple of trading days is that the bonds actually rallied massively. And I want to really look at December 6th and December 7th. That divergence is happening a little bit today, but not as strong as what we've seen over the last 2 trading days. So on December 6th, the bonds rallied 1.29%. This means that actual interest rates, that yields on these bonds went lower. Typically, when yields have went lower in 2022, stocks have rallied. So when bonds are up 1.29%, you would expect to see the stock market up big as well. But what happened on December 6th? The stock market was down 1.44%. Just destroyed. 1.5%. The NASDAQ was down over 2%. Very, very abnormal. And if we look at the big rally that we seen on December 7th, that was yesterday, bonds went up 2.36%, so yields dropped sharply. That means easing of financial conditions. And 2.36% on a TLT rally is massive in a day. What happened on December 7th? The stock market actually closed negative. It closed down 0.17%. This is abnormal for 2022. Now, the question is, why are bond yields falling and the stock market is also falling as well? There could be a couple reasons for this, but the obvious one is economic uncertainty, fears of a recession. When a 10-year bond is yielding you about 3.5%, and you're not going to expect to get that just cyclical growth out of certain segments of the stock market, well, that 3.5% yield looks pretty good. And right now, what you're seeing is that rush to safety into bonds. So people are buying the bonds, they are selling off the stocks. This is actually a normal market correlation besides for 2022. 2022, the whole year has been very abnormal between bonds and stocks. It's actually normal relative to history to see bonds go up and stocks go down. But considering where bonds are right now and the economic uncertainty, it looks like fears over a recession, fears about growth slowing down. So the higher you see TLT go, it might start to actually push down the stock market even more. And the more and more that starts to happen, one, the less concerned the markets are with inflation, but more concerned the markets are with an economic downturn or a recession. So that's important to keep in mind, but it will mean more downside for stocks to come, and it is very concerning. Now, let's get into some of the other data that you need to know. So what actually came out today was that the US labor market's still tight despite continuing jobless claims hitting a 10-month high. Weekly jobless claims increased 4,000 to 230,000. Continuing claims rise 62,000 to 1.671 million. Now, the weekly jobless claims number, this was right on economists' expectations of 230,000 claims. This one, 62,000 claims more, that was over their estimates. So it's showing the labor market is starting to cool down, but it's not even close to what you could say as a cool down labor market. People are still, gaining 250,000 jobs a month per the actual jobs reports, guys. So that is a big reason why the markets actually did rally today, because the labor markets showed signs of cooling down. But one data point does not make a trend, but it can start a trend. So we want to pay attention to that, and that's why the stock market was really only up, a little bit over 0.5% to close out the day with the S&P, because it's not a huge data point, but it is definitely a good sign. Now, if we go ahead and look out to tomorrow, what we are going to get. So at 12:30 p.m., you are going to get PPI month over month for November. We are expecting a 0.3% read. The last month's read was 0.2%. Economists were right on with their expectations of 0.2%. So we are expecting PPI to go up a little bit. If you guys are unfamiliar with what PPI is, it is producer price inflation month over month for November. Essentially, what it's saying is if producers' inflation is going up to actually mine raw materials or transport things, and there's a lot of promising signs there that inflation is starting to ease in those sectors. Well, if their costs go up, they tend to pass those on to consumers. Wages and the actual producing of goods are the things that contribute to prices going up the absolute most. So that will be very important tomorrow. You will also get core PPI month over month for November, core PPI year over year for November, and PPI year over year for November as well. Now, I think the biggest data point of tomorrow will be the Michigan Consumer Sentiment Survey, the preliminary survey for December, coming out at 2 p.m. And why will this be so important for markets? Because Fed Jerome Powell is deathly afraid of people, average citizens, starting to expect higher prices, aka starting to factor in more inflation into their lives. Because when they do that, it basically gives a green light for businesses to start raising prices. You might say, for an example, a business might have raised prices in January because they knew high inflation was coming. And then if people are just expecting that now, they're going to start raising prices every single year. And that's where you start to get very sticky inflation. And that's where you get to a place with a very big inflation problem. So the consumer expectations for inflation will be probably the most important thing, but you also want to see consumer confidence, how they are feeling in the economy as well. That will also be massively important. Now, tomorrow you do also have at 2 p.m. coming wholesale inventories month over month for October. A lot of different data points, right? And the big data points out of the Michigan Consumer Sentiment Survey right here will come out separately at 2 p.m. The Michigan 5-year inflation expectations, Michigan consumer expectations, and Michigan inflation expectations, all for the month of December, will come out at 2 p.m. as well as the Michigan Consumer Sentiment Survey, guys. So there is all of that information. Those are the biggest things playing a role in the markets this week. For next week, you're going to have Fed Jerome Powell, the FOMC meeting. You're going to have CPI coming out on Tuesday, Fed Powell on Wednesday. You're going to have a real shakeup heading into the end of the year based off of what is exactly said. And I don't want you guys to be fooled here. The bond market might be snitching to you that things in the economy are not okay. So in a weird way, the more dovish the Fed gets, it might spell more pain for the stock market, because after all, the day that Fed Jerome Powell spoke last, that was our big green day, right? And then you went up a little bit intraday the day after. You were up 3% the day Fed Jerome Powell spoke. And then virtually every single day after that has been red besides today, guys. So keep all of this information in mind. Save this video. Share this video with someone that needs to hear this information. Just to wrap this video up, would be very, very careful buying the S&P at its current levels, because fundamentally speaking, if JP Morgan, Bank of America, as well as Morgan Stanley and even Goldman Sachs are correct, the stock market is grossly overvalued. They would need to be very far off with their 2023 calculations and forecast for the stock market to make sense buying it at these levels, guys. So that is it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Where do you think a fair value is for the S&P? What are you doing in your portfolios? Literally give me all of that information. I need it, baby. Thank you for watching, and I will see you in the next one.